The word accounting might sound a little intimidating, right? But what if I told you it's actually the true language of business? Seriously. And if you can understand it, you hold the key to knowing how money really works. So let's dive in and learn the fundamentals together. Okay, let's imagine you start a lemonade stand. Your very first customer comes up, buys a cup, and puts cash right in your hand. Awesome. That means you're profitable, right? Well, not so fast. That cash you're holding doesn't tell the whole story. What about the cost of the lemons, the sugar, the cups? To get the real picture, you need accounting.
So, here's our game plan. First, we're going to look at why accounting is basically the ultimate scoreboard for any business. Then, we'll uncover the one simple, elegant rule that keeps everything perfectly in balance. After that, we'll see how every single move is tracked, how all that data builds a financial story, and finally, how you can start reading between the lines. So, what is accounting, really? Well, it's so much more than just counting beans. It's a system that turns total financial chaos into crystal clarity. It helps a business answer all the crucial questions, like, hey, should we buy more lemons? Or can we actually afford to hire some help? Or is it time to raise our prices? It's all about making smarter decisions.
Think of it this way. Accounting is like the dashboard in your car. It takes all this incredibly complex data from the engine and presents it in a way you can actually understand at a glance. Your speed, your fuel, your engine health. It tells you if you're winning, losing, or just kind of cruising along.
All right, let's get to the absolute heart of it all. This is the foundation of all accounting. And it's not some scary, complicated formula. It's a simple, perfect rule of balance. Everything, and I mean absolutely everything in accounting, comes back to this one core idea.
First up, what does the business actually own? These are its assets. So for our little lemonade stand, that's the cash sitting in the jar, the lemons and sugar you haven't used yet, and yeah, even the physical stand itself. These are all the resources the business can use to make money in the future.
Okay, next part. What does the business owe to other people? These are its liabilities. Maybe you got a small loan from your parents to buy that first bag of sugar. Yep, that's a liability. Or maybe you owe a supplier for that big box of cups they dropped off. That's a liability too. It's basically a claim someone else has on your assets.
And finally, what's left over for the owner? For you. That's your equity. It's the money you personally put in to get the whole thing started, plus any profits you've earned and decided to keep in the business. It's the owner's claim on all the assets. And there it is, the golden rule. Assets equals liabilities plus equity. What you own is funded by either what you owe to others or what you've put in yourself. This equation must always, and I mean always, stay in balance. After every single transaction. It's like the law of gravity for the financial universe. Okay, so if this equation has to stay perfectly balanced all the time, how in the world do we do that? The answer is a totally brilliant system that was developed by merchants in Venice over 500 years ago. And believe it or not, it's still the gold standard today. It's called double-entry bookkeeping.
The main idea is actually pretty simple. For every financial action, there's an equal and opposite reaction. So if an asset like your cash goes up, something else has to change to keep that perfect balance. Maybe your equity goes up, or maybe another asset goes down. The key is, two accounts are always affected, no exceptions.
Now, this is all managed through things we call debits and credits. And forget anything you think you know about those words. In accounting, just think left and right. That's it. Let's walk through a quick example. Say you invest $100 of your own money into the stand. Your cash, which is an asset, goes up by $100. That's a debit on the left side. At the exact same time, your personal stake, your equity, also goes up by $100. That's a credit on the right side. See how it works? Two entries, left and right, keeping that equation perfectly balanced.
And this all follows a really clear cycle. First, a transaction happens, you sell a cup of lemonade. Second, you record it in your journal, which is basically a chronological diary of the business. Third, you post that entry to the ledger, which is where you group all the similar transactions together, all the cash stuff here, all the sales stuff there, and finally, you use those organized totals to create the final report cards.
So all that tracking and balancing and organizing, it's not just for fun, right? It all leads up to the grand finale, the financial statements. This is the moment where all that raw data gets transformed into a clear story about the business's actual performance and health.
The first report card is called the income statement, and it answers one really simple question. did we make money over a certain period of time, like a month or a year? You take all your revenues, let's say $50 from lemonade sales, and you subtract all your expenses, say $20 for the lemons and sugar. What's left over is your net income, your profit. In this case, a cool $30. Next up is the balance sheet. Now, this isn't a story over time. Think of it more like a snapshot, a photo of the business on one specific day. And this is where our golden rule comes to life. On one side, you've got your assets. On the other, your liabilities and equity. And check this out, that $30 profit from the income statement flows right into your equity. Your original $100 investment plus that $30 profit gives you $130 in equity, which perfectly balances out your $130 in assets. See, it all connects.
But here's the thing. These statements aren't just report cards on the past. They're kind of like a crystal ball. They let us analyze the health of the business and make really critical decisions about its future. This is where accounting becomes a genuine superpower.
One of the most powerful ways to do this is with something called financial ratios. These are just simple calculations that tell a much deeper story. For instance, a liquidity ratio answers a vital question: if we had to pay all our bills tomorrow morning, could we actually do it? And the most common way to check this is with the current ratio.
So let's say our lemonade stand has $100 in cash, but it still owes the grocery store $40 for that last batch of lemons. We'd calculate the current ratio by simply dividing our assets by our liabilities. That gives us 2.5. Now that single number tells a really powerful story. For every single dollar we owe, we have $2.50 ready and available to pay it off. That is a very healthy sign. It shows our little business is financially stable.
And that brings us right back to where we started. The legendary investor Warren Buffett famously said, "Accounting is the language of business." But getting a handle on assets, liabilities, debits, credits, and how they all build into these financial statements, you've just learned the fundamental grammar of that language. You can now start to understand how any business, from a tiny lemonade stand to a giant global corporation, truly works.
So, I'll just leave you with this thought. Whether you're dreaming about starting your own business, or maybe investing in the stock market, or even if you just want to better understand the world around you, you now have the key. You can look right past the flashy headlines and read the real story, the one that's told in the numbers. So now that you know the language of business, what stories will you choose to read?